Okay, everyone, I'm going to take you through a consolidated cash flow statement. And the good news about this is once you get the consolidated balance sheet and income statement completed on your worksheet, the cash flow statement doesn't present that much of a problem. I know that's easy to say, but because typically cash flow statements, if you're ever tasked with having to prepare one, and once you get into your job and profession, you'll find it's pretty arduous. But when you do it on a consolidated level, the first thing you have to do is take care of the consolidated balance sheet and income statement. And by doing that, you've kind of worked through a lot of the prickliness and the technical issues. And then so doing the cash flow becomes very straightforward, as if you were doing it just for a standalone company. But so before I lull you to sleep with all the oversimplification, let's talk about what we have here. This is the end of chapter 6, comprehensive problem. The first thing they want us to do is this cash flow statement. And anytime you do this, the first setup that you do is you will juxtapose or place side by side for comparison your balance sheet, and so you'll see your two years here, 2013 and 2012. This is all of this stuff right here is right out of the textbook. So I had to do the work to just input this into the spreadsheet. So I've done that for you, and you can use this as a template as you go forward. Now all the nice Christmas colors over here to the right, all I've done is I've taken each column. You can see the formula, and I've done an absolute value, so I don't have my negatives and positives. I just said what is the change between year over year. So I'm taking the change from 2013 to 2012. So you can see that the absolute difference here is $80,000 in my cash, and then so I'm showing that difference in this column. And all I've done is I've color coded. I've taken out the signs. As you can tell, there's no positives or negatives. And then I've shown whether it was an increase or decrease, and of course then those translate. If it's an increase in an asset, it translates to a use. Now remember from your intermediate accounting, when you learned about cash flow statements, actually maybe you learned about it in the accounting principles, which is a good thing, but if you have an increase in an asset, that is a use of cash, and so you need to think of the mental model of what causes or what typically can cause an increase in an asset. Maybe you went out and bought an asset. Maybe you recorded an asset like a receivable because you're accruing revenue, but you haven't received the cash. So that's why it's considered a use of cash, and all of your assets are treated the same way. If they go up, then you're automatically thinking that it's a use. And if an asset goes down, then you're automatically thinking that's a source, because let's assume you collected that receivable and the receivable went down, but that actually created a source of cash. So when the assets behave like this, then you have to label them as a source or use. And then it basically is the flip side of that on the liabilities. If you have a liability that goes down, like in this case, the payables went down, we're going to make an assumption that we paid those, and so therefore we call a decrease in payables a use of cash. And conversely, if a payables balance goes up, the best thing to think about is something like long-term liabilities that went from $550,000 to $650,000. And so what maybe happened is we maybe borrowed money, and so therefore we had a $100,000 increase in the liability, and we labeled that as a source. So this is all of this stuff right here. Everything in this block is nothing but preliminary housekeeping that you need to do to kind of set yourself up to be able to prepare a consolidated statement of cash flows. And this is, you would do this in any scenario. It's just that these two columns right here, my 2 years that I am juxtaposing to get my differences, those two columns are coming straight off of the consolidated worksheet. The final column, the consolidated balances, that's where you're getting these numbers. So make a point of that. And that's kind of saying what I said earlier, and that is you do all the work and the blood, sweat, and the tears to come up with those consolidated balances. Then when it says, okay, I've got my balance sheet, I have my income statement, I have my statement of changes in retained earnings, and the last one you want to do is your statement of cash flows. And so you've done all that hard work, and so then you can do this, what we're showing in the spreadsheet, and just place them side by side and do your cash flow statement. Okay, so that's all my backdrop, and obviously what I'm trying to do with the statement of cash flows is prove this $80,000 change, and it's an actual increase in cash. It went from $130,000 to $210,000. So what do I have to do then to show why did I go up by $80,000? Well, you all know from your learning in cash flows about every company, and this is probably a 99 point, I don't know what percentage of companies are going to use the indirect method. That's vis-a-vis the direct method, where you have to show specific categories of operating cash, like collections from customers and payments to vendors. You don't do that in practice because it's just much easier to go ahead and take the indirect method. And the book talks about if you even did the direct method, you still have to do this reconciliation between net income and operating cash flows. So the first thing we start with is our net income. And now we're not going to get net income from this table, because you can see that retained earnings did change. It went up, and my suspicion is it went up primarily because of net income. You know, that's obviously what happened, right? That's how net income or retained earnings changes. If it was a net loss, then it would have gone down. But so in this case, you look at the problem, and the very first bullet, I'm reading from the consolidated, the comprehensive problem at the end of the chapter, and it says we had consolidated net income of $178,000. So I just dropped that number in, and that's my starting point. Now, we have a section here that says we have to reconcile the net income to the cash flow from operating activities. And I'll get to some of these captions in a minute, the gain and the depreciation, but let's take the easy stuff first, and that is the changes. These three captions here, accounts receivable, inventory, and accounts payable. Think of these as your operating assets and liabilities, the current assets and current liabilities you have. And so those are where we'll just go ahead and grab our numbers off the table above. And so I had right here, I went ahead and labeled it for you, an increase in accounts receivable. How much was that? It went up 130,000, so I'll just drop that number in here. And it's a positive number because it's a source of cash. Excuse me, not a source. It's going to be a use of cash. I misspoke. I'm kind of glad I did that. So it needs to be a negative number. Now, let me explain a little bit of theory on why that is. If accounts receivable went up, when you record your sale and you're debiting accounts receivable and crediting revenue, that is augmenting or bolstering or causing the number to increase. It's causing net income to go up. I mean, that should make sense to you. As I book revenue, my net income is going to have a positive effect on it. But when I'm booking that, and if over the period my receivables went up, that means that what happened to cash? Well, if what's in this number here is an accrued number, and I'm trying to reconcile that to the true cash number, I have to back that out because it did not provide cash. It helped this number get bigger, but it didn't provide cash. So I'm going to kind of purify that number by taking out that increase in accounts receivable. Likewise, I have an increase in inventory right here, 42,000. So I'm going to put that in as a negative number. Okay, and then my payables, it says I have a decrease in payables. Well, remember the thing to think about there, if payables went down, I probably paid some, right? So that's a $6,000 considered a use, that decrease in payables. So that's going to be a negative 6,000. Okay, now a couple of other things I've got to do here. I've got two line items, one for depreciation and one for the gain on the sale of building. Let's talk about depreciation first. Most of you understand, and hopefully you will as soon as you're finished listening to this, depreciation is a non-cash expense. When did the cash happen? The cash flow happened when you bought the item, when you bought the building or the land, or, well, you don't depreciate land, so I shouldn't have said that, but the building or the equipment or whatever the asset is that you're going to depreciate. The cash flow came when you bought it. And that's obviously cash goes out the door and you get the asset on your books. And so now you're going to allocate that historical cost of the asset, what you paid for it, You maybe paid for it last year or 5 years ago, but you're going to be allocating that amount via depreciation. You're going to allocate some of it to expenses so that you can satisfy the matching principle, because you're using up that asset in terms of, wearing it down, using it up, and as you do that, hopefully that asset is helping you create revenue. So you're matching revenue with expenses. So that's the theory behind that. But what we've got to do now, I would ask you a true-false question. True or false is, did depreciation expense, is it within this number of net income? Did it hurt that number? Was it a reduction of your total revenues and expenses in order to arrive at net income? And the answer is true. Yes, it did have a dampening effect on net income. So what I need to do, I'm trying to purify this number to make it reflect what I truly have as my cash flow from operating activities. I need to add that back. So what do they tell me? Well, and the neat thing is you've already looked at depreciation through the act of doing the consolidated worksheet. So the second bullet point on your problem says consolidated depreciation and amortization equal $52,000. So I'm going to have a positive number, $52,000, that I add back to net income. Again, I'm trying to purify that. Now that's just kind of a coincidence right now that excuse me, that my net cash flow is $52,000, but it's about to change because we're going to talk about the gain on sale of building. Now, if you go down and look in your given information, you will see that that they did have a gain on sale of building. It's the third bullet point, and it says on April 10th, Sun, who's a subsidiary, sold a building with a book value of $40,000 and received cash of $50,000. Now, what is that? Well, if the book value, cost minus accumulated depreciation, is $40,000 and they got $50,000, well, there's my $10,000 gain. So that gain, and I think get your mental model going. Did the gain, or is the gain, reflected in this number? The answer is yes, it is. Now, I'm going to take that out. I'm going to use the gain as a reduction. Just know that that rule. The gain is a reduction, and the reason is I'm going to then show on the sale of the building down here. Let's go ahead and drop that number in. Well, what did I sell the building for? I sold it for an entire $50,000. That entire $50,000 is a source of cash. Now, but remember, when I recorded that, I had this $10,000 gain that's up in this number. So I'm taking it out, taking the gain out of net income in order to not double count it. This is a double counting. If I were to not take it out there, but I show the gross proceeds down here in the sale, then it's going to be reflected twice on my statement of cash flows. So that's the reason for that that gyration there, that we pull out the gain from net income so that we can show the gross proceeds down below in our investing activities. Now, continuing on in the cash flow from investing activities, if you look at the problem and the information they give you, the third bullet point down, we're not quite done with that yet, because it says after this, they said they sold the building with a book value of $40,000 and got $50,000 cash on that sale. They borrowed $100,000 from a bank. That we're going to talk about that in the financing activities. But then the last statement, it said they purchased equipment for $60,000, and they also say these transactions were all with outside parties. And so that statement basically says, hey, this is now something you'd show on the consolidated statement, because remember, from all your prior chapters, the reason we do a consolidated set of statements is to say, as one entity, what would this look like? So it's important that it be with the arm's length and outside parties that we're going to then show that. So that purchase that they made, as you may intuitively know, that's going to be a use of cash. So we'll put it in as a negative number. $60,000 as a use. And so at this point we're at $10,000 negative. I'm going to check myself here and on my completed, and I know that's correct. Now, one thing you can do to check yourself, and it gets a little bit cumbersome here, is again, you think about the way algebra works and the fact that accounting is set up to be all your assets balanced to the total of your liabilities and equity. So it goes without saying that if we want to explain the change in cash, the change between these two period ending numbers, which is $80,000, then if we explain everything else below that, I'll paint this down here, if we explain all these other changes, then we will have succeeded in explaining this $80,000 change, and that's what the purpose of cash flow statements are. It's to, or what the purpose is, it's to explain how cash was used or received in the business. Now, by looking at equipment, buildings, and then if we kind of throw those covenants in here also, the net numbers, the net difference is $32,000. Well, where does that come from? It comes from this $52,000 of depreciation, because again we're showing these on a net basis, see that? And it also comes from, we had a sale of building. Now that was the proceeds, and remember there was a gain on this. So the net book value, they said, was the $40,000, the $50,000 minus the 10, and then the purchase of equipment was 60. So if we look at all those in total, it will have then explained this $32,000 net change between land, buildings, and equipments and covenants. And the covenants, again, that decrease is simply the amortization that we're taking. All right, now we can keep moving on to our last section where we're looking at our financing activities. And remember, cash flow statements has 3 sections: the operating activities, the investing activities, and the financing activities. In financing, where we turn our attention to is on the long-term liabilities and the stock. I'll leave retained earnings out of that, although we can have dividend payments certainly are a financing activity which affect retained earnings. So maybe I should just go ahead and paint that. But as you remember, the other cause of this change in retained earnings here of $122,000, well, a big piece of that was the consolidated net income, that $178,000. So I know if I had that much net income and my retained earnings only increased by $122,200, then what do I assume happened? Well, one of the things certainly is going to be the payment of dividends. So let's look at what we have in the problem. And you can see in the well, let's maybe take some of the stuff we've already mentioned, and like in the third bullet point, there was a borrowing from a bank. Remember, that was $100,000, and so you would know intuitively that it's going to be a source of cash, so a positive number of $100,000. And then we had a payment of cash dividends by the parent company. And the dividends that they paid, you look at the fourth bullet point, and let's read that together. During the year, POP paid $40,000 dividends on its common stock and $10,000 dividends on its preferred stock. Then it also says, and Sun paid a $20,000 dividend on its common stock. Well, the thing to think about there, or ask yourself, what about that dividend that was paid by the subsidiary company? Now go back in the problem and you can see that the parent owns 90%. So we're going to have a 10% non-controlling interest here. Okay, and those folks that own that 10% of stock are going to receive some dividends, and on a consolidated basis, what the company's going to show them, let's go ahead and knock that out, is the payment of cash dividends to the non-controlling owners of Sun, that 10%. So we'll take the 10% times the $20,000, and again I'm getting this on the fourth bullet point of the problem, and so I'll have a negative $2,000. Okay, I'll say that again. That is a dividend payment by the subsidiary called Sun, and this payment, all I want to show on my consolidated statement of cash flows is the dividend payment that is going to the 10% of the shareholders who are the non-controlling owners. Okay, so I took the 10% times 20,000. That's how I got to the $2,000. Now, of course, the dividends that POP paid to its shareholders, whoever they may be, that whole amount we are going to show, and of course it'll be a use of cash. And so what does it say in the fourth bullet point? It says they paid $40,000 of dividends. So I'll put that as a use of cash. We also paid a dividend to our preferred shareholders, and that dividend amount was $10,000. So what I need to do is add that to, in this case, I know I'm showing a negative number here because it's a use of cash, so my grand total is a use of cash of $50,000 on this payment of dividends. So now I've got my my investing activities. Excuse me, I realize I've got a typo here, and that should be financing. That's what I get for doing copying and pasting. You gotta love Excel for the efficiency, but sometimes that happens. So, all right. So now the financing activities are showing a net cash inflow of $48,000, and so things are looking pretty good here because all of these captions, my operating, investing, and financing, net together to be the $80,000 source or increase in cash, and there that is. So, and from a matter of form, what you'll normally do in a statement of cash flows is you'll go ahead and put the balance at the beginning of the year, which we can go ahead and use a formula and just grab that balance of 130,000, and then let's just prove that the 210,000 sure enough is our ending balance. You can see that there, and here we are. So congratulations, you've now completed a consolidated statement of cash flow, and I'll reiterate that the main difficulty in doing a consolidated statement of cash flow is really getting everything done that you've already been trained to do, and that is to get to the point where you have an accurate consolidated balance sheet and a consolidated income statement. And so now it's just all those facts that you've worked through, and you can have that in at your fingertips, and then just go ahead, and again, the first thing you will do is do this side by side comparison of your balance sheet. So just get used to the fact you're going to have to lay this out in a spreadsheet. You're going to have to compute your changes. Now, this is not all plug and chug. Okay, we don't just grab these numbers and drop them in. Sometimes you do when you're talking like about your increase in your operating assets and liabilities. That's all well and good. But the other stuff, you don't just take this $30,000 and drop it down here. That's a common mistake that students make. What you have to do is say what all came into play in this case for this $32,000 decrease. Well, you have, well, remember what that was. It was depreciation and amortization. It was gross proceeds from sales. It was taking out the gains so that we don't double count it. So as good accountants, and you're going to graduate from California Baptist with a degree in accounting. So the good accountants are the ones that don't shy away from creating these statements of cash flows. The good accountants are the ones that step up to the plate and get them done. So this is an important skill, and this is why hopefully you didn't think, oh, I finally got through that in intermediate accounting, I'll just forget about it. It's going to keep rearing its head. So congratulations on getting this done, and we'll move on in the next video and talk about earnings per share. Thank you.